In this video, I'm going to be reviewing some of the accounts that we find on financial statements and the accounting methods we use for those accounts. So assets, we've talked about how assets have future economic benefits. They are the resources that companies have with which to earn a profit. And we've talked about how with assets on the statement of financial position, they have to be classified as non-current and current. So non-current assets are going to include intangible assets, investments, and property, plant, and equipment. Current assets include things like cash and cash equivalents, trade receivables, supplies, inventory, short-term investment, prepaid expenses are all examples of current assets. And when we put our assets on the balance sheet, the current assets are going to be listed in reverse order of liquidity. So if you recall looking at a classified balance sheet in the last video, the non-current assets are listed at the top of the statement, followed by the current assets, with the current assets listed in reverse order of liquidity. So when we use that term liquidity here, we mean how easily they can be converted to cash. Cash is already cash. It is the most liquid of your assets. It's listed last. So often what you see listed first on a classified balance sheet prepared using International Financial Reporting Standards is intangible assets will be listed first. So intangible assets are assets that do not have a physical or financial substance, but they have value because of the rights that accrue to the holder. So a patent is a good example of an intangible asset. You can't really reach out and touch the patent, but if you have the patent, it gives you the exclusive right to use a product or process to generate revenues for a period of time. And so those are the rights that accrue to the holder. So some intangible assets have limited lives, such as patents, or unlimited lives, such as goodwill. Patents are valid for a specific period of time, and in a lot of cases, let's say the patent might have a useful life of 20 years, but it's going to be obsolete within 5, so we would use 5 years as the useful life for that patent. Intangible assets are going to be recorded as at cost, and when we use this term cost, we mean all cost incurred to get the asset ready for its intended use. So that is true of all assets, not just intangible assets. They are going to be recorded at cost. Cost includes all the cost incurred to get the asset ready for its intended use, and cost is fair value at the acquisition date. So intangible assets that have limited lives are going to be amortized, meaning that the cost is going to be charged to expense over the asset's life in a systematic manner. And typically that is going to be done using what we call straight line amortization. So if we bought a patent for 50,000 euros and we expect it to have a 5-year life and not be worth anything at the end of 5 years because it's technologically obsolete, we would take the $50,000 or 50,000 euros, we would divide it by 5 years, and we would charge $10,000 per year to amortization expense and decrease the patent account by that amount. So other intangible assets have unlimited lives, and if an intangible asset has an unlimited life, we're not going to be amortizing it, so IFRS requires that we impairment test it annually. So the idea with impairment testing is that we want to make sure that the value of that patent has not fallen significantly below its cost, because if the value of the patent has fallen significantly below its cost, we'll be overstating our assets if we just leave it sitting on our balance sheet at the cost. So the idea with an impairment loss is you need to write the value of the asset down to fair value. So all intangible assets should be impairment tested if the holder has reason to believe that the value of the asset may be impaired, but if they have unlimited lives, they need to be impairment tested at least annually. So typically, intangible assets are recorded at cost and amortized or impairment tested, but under IFRS, companies do have the option to revalue their intangible assets at the balance sheet date. If a company chooses the revaluation option for intangible assets or property, plant, and equipment, once they choose that for a specific class of assets, they have to continue to use the method as long as they have the assets. So revaluation might mean that you revalue it upwards 1 year and you revalue other assets downward the next year. So once again, that revaluation adjustment is something that we would report as other comprehensive income on a comprehensive income statement, and it would be reflected on our balance sheet as accumulated OCI, revaluation surplus. So two common types of intangible assets are patents and goodwill. They're both long-term. All intangible assets are long-term. As I mentioned, it has a limited life. The limited life could be set by regulations. It could be set by technological obsolescence. The cost of the patent is going to be amortized over its useful life. The amortization reduces the patent account balance. That is under the cost method. We could also be using the revaluation method for that patent. A second type of intangible asset that we see pretty often on balance sheets is goodwill. So goodwill is only going to be recorded in connection with the acquisition of another business. So if we go out and acquire another business and the price we pay is greater than the fair value of the business's net assets, that is what we're going to record as goodwill. Because it could be that in acquiring that business, we are acquiring assets that are not on the balance sheet. A company's reputation is not going to be on the balance sheet. A company's well-trained workforce is not going to be on the balance sheet. So those are the kinds of things that companies are willing to pay extra for, and they wind up getting recorded as goodwill. So goodwill has an unlimited life. It's not amortized, but it is subject to annual impairment testing. Some examples of other intangible assets: computer software, licenses, trademarks, films, copyrights, and import quotas. So those are all long-term. Typically, those have finite lives, so they are amortized. The next category that we might see on a statement of financial position is investments. Companies make different types of investments. They might invest in land for speculative purposes. They might loan companies money and record notes receivable. They may have excess cash that they choose to invest in notes receivable. So a note receivable can be current or can be non-current. The ones that are going to be reported in investments are non-current. The current ones would be reported as current assets. And these notes receivable are going to be either reported at amortized cost or fair value. If they have a fair value that's readily available, you would report that at fair value. Otherwise, you would report at amortized cost. Companies also make investments in the stocks and bonds of other companies. In some cases, those stocks and bonds, the investment might be made with the intent of selling the investment in a short period of time to make a profit on short-term price fluctuations. Those are called trading securities, and they are reported as current assets. In other situations, companies might buy an investment in the shares of another company because they want to cement the relationship with one of the suppliers. They may have an investment in an affiliate or an associate where they have bought a controlling interest in the stock of the other company. In those cases, they are not going to be selling those shares in the short run. They are going to be long-term investments. So investments in affiliates or associates are typically going to be accounted for using the equity method, and they may be reported at fair value. The default treatment is equity method, but companies do have the option to report them at fair value. Investments in equity instruments, or in other words, investments in the stock of other companies that don't report a controlling interest. Maybe we have a 2% interest or a 0.2% interest, but we've bought this stock with the intention of holding it for an indefinite period of time. So those types of investments are going to be reported at fair value. And then finally, investments in debt securities, where instead of buying the stock of another company, we've bought them as bonds. Once again, this can be current or non-current. They are going to be recorded at cost, and they're going to be adjusted at the end of each period so that they are reported at fair value. The next category we might see under non-current assets is property, plant, and equipment. Property refers to land that you are using in the business. So this is not land that you've bought for speculative purposes. That land is in investments. This land is the land that your building or your parking lot is sitting on. So we're going to record it at cost. Land does not wear out, so it's said to have an indefinite life or an infinite life. And so because there is no useful life, we're not going to depreciate it or charge its cost to expense over a period of time. So property, plant, and equipment are all subject to revaluation if a company chooses that option. Most companies do not. So most companies are going to record property or land at cost. They are not going to depreciate it, and it is going to be subject to impairment testing. Plant or buildings and equipment are other types of long-term tangible assets. They get recorded at cost. Plant and buildings are going to wear out. We are going to have to eventually replace them. They have a useful or a finite life. So like we did with the patent, we're going to take the cost of that asset and charge it off to depreciation expense in a systematic manner. We could use straight line like we did for the patent, but there are other options that are available as well. Once again, the default treatment is to report these buildings and equipment at book value, or cost minus accumulated depreciation. Companies do have the option to revalue these assets. Not many businesses do it, and then they are subject to impairment testing. So when we record depreciation on the plant and the equipment, we're going to increase depreciation expense for that, and then the other part of the transaction is going to be recorded in what we call a contra asset account. So we'll have the plant account, and then we'll have a provision for depreciation for the plant account, and then the same for equipment. We'll have the equipment account, and then we're going to have a provision for depreciation for the equipment. And essentially what's in those accounts is all of the depreciation charged to date on that asset. So those assets are reported at book value, which is going to be the amount in the plant account minus the provision for depreciation for the plant, and the amount in the equipment account, essentially its cost, less whatever's in the provision for depreciation equipment account. So once again, we say that they are reported at book value, which is the cost, which is recorded in the asset account, minus what's in the contra asset account. So moving on to our current assets. Current assets include cash and cash equivalents, inventories, short-term investments, trade receivables, and then other items such as supplies, prepaid expenses, and some other types of current assets. So cash and cash equivalents refer to essentially the cash in your checking account. A cash equivalent is where you have taken your cash and invested it for a short period of time in some kind of highly marketable security. So it is so near to cash that we classify it as cash. Inventories are current assets. They're goods purchased for resale. So remember, we said that current assets are those that we expect to use up or convert to cash within 12 months of the balance sheet date. You should not have more inventory on hand than you would be getting rid of in a year. So inventories are current assets. They are going to be recorded at cost, and then we're going to account for them using a cost flow assumption. So examples of cost flow assumptions under IFRS include FIFO, which stands for first in, first out, and average cost. Inventories are reported on the balance sheet at the lower of cost or net realizable value. So when we go out and buy inventory, we record it as an asset because it has future benefits. We are going to sell it and generate revenue. So we record it as an asset, inventories, when we purchase it, and then as we sell it, we transfer the cost out of the inventory account and into the cost of sales, which is an expense account. So you buy inventory, you increase the inventory account. You sell inventory, you decrease the inventory account and increase the expense account, cost of sales, or cost of goods sold. Another type of current asset are going to be the short-term investments I spoke of earlier. Trading equity securities are purchased with the intent to sell them in the short term to profit from short-term price fluctuations. They are recorded at cost and reported at fair value. So the notation FVPL stands for fair value through profit and loss. So when it is identified as FVPL, that tells you that that unrealized holding gain or loss is going to be reported on your income statement as opposed to FVOCI, which tells you that the unrealized holding gain or loss is going to be reported in other comprehensive income. All right, so here for these short-term trading equity securities, they are fair value through profit and loss, or FVPL. Trade receivables, these are amounts due from customers as a result of credit sales. They are an asset because the future benefit is going to be the cash that we receive. Trade receivables are generally due within 30 or 60 days, so therefore they're classified as current assets. In some cases, we will not collect all of our receivables. Typically, we're not going to collect all of our receivables, so these are going to be reported net of a reserve or a provision for bad debts or uncollectible accounts. All right, so other current assets, supplies, where we've gone out and purchased various types of supplies. If you pay for an expense that benefits the current period, you're going to record it as an expense. But if you prepay your expenses so that the expenditure is going to benefit future periods as well as the current one, then you're going to record that as a prepaid expense. So this might be prepaid insurance, prepaid advertising, prepaid rent, and so on. In all of those cases, the prepaid expense is not an expense account. Prepaid expense is an asset because the payment is going to benefit future periods. So liabilities, we know, have to be divided into current liabilities and non-current liabilities. The types of current liabilities you would expect to see would include interest payable, trade payables, salary payable, income tax payable, and then unearned revenue or unearned service revenue in this case. So in most of these cases, cash is owed to suppliers for loans and for accrued expenses. So we are going to be making a cash payment for interest payable. If you borrow money, you're going to incur interest expense. And in the period between when you have incurred the interest expense and paid it, you have a liability, interest payable. Trade payables are amounts owed to suppliers for goods and services purchased on account. So perhaps we buy inventory on account, which basically means we charge it. We have a trade payable on our books until we pay that account. Salaries payable are going to be amounts owed to our employees. Interest payable, salaries payable, income tax payable, all of those are sometimes referred to as accrued liabilities. So an accrued liability is going to be for an expense that you have incurred but not paid. So our employees have worked, but we haven't paid them yet. Salaries payable. We earned revenue and expenses and net income. So we have taxes that we're going to be paying. We have estimated the amount that we owe, but we haven't paid it yet. We have a bond outstanding. Interest is not payable at this time, but we have incurred the expense. So when we put together our income statement and our balance sheet, the interest needs to be reflected there. All right, so once again, in all those cases, those are going to be satisfied with cash. Then finally, we've got unearned revenue or unearned service revenue. And this is where a customer has paid in advance for goods or services. So it's generally going to be a current liability because they're not going to pay for more than a year in advance. So the cash has been received before the goods or services have been delivered or performed. So the obligation is to perform the service or deliver the goods. So those are all examples of current liabilities. Non-current liabilities are typically going to be types of long-term debt. Bonds payable are debt securities that the company issues to raise capital on the capital market. They are long-term. They might be 5 years, 10 years, 15 years, and so on. They are interest-bearing, and they are going to be reported as non-current or long-term liabilities, except in the period when they mature. A bond payable is a form of a note payable. A note payable is where we have either borrowed cash or perhaps we have purchased goods on account and we want a longer period of time to pay. A note payable can be current or it can be long-term, but in either case, you are going to owe the principal amount of the note as well as interest on it. And then finally, frequently you will see in the non-current liability section a deferred tax asset or liability. And deferred tax amounts arise because we might use one accounting method for financial reporting purposes and another for tax reporting purposes. This is not disallowed. When we're doing our financial accounting, we're using IFRS, and when we're doing our tax accounting, we're using the Internal Revenue Code for whatever country we're being taxed by, and they have different methods. So those give rise to deferred tax assets and deferred tax liabilities. So moving on to revenues and gains. We've talked about how the difference between revenues and gains has to do with whether it is primary ongoing operations or peripheral. Sales revenue and service revenue are both operating revenues. Service revenue we record in connection with the provision of services, where sales revenue we record in connection with the delivery of goods. If a company has an investment in the stock of another company, they might receive dividends and report dividend revenue. They're only going to report dividend revenue if they have a less than 20% interest. If they have a more than 20% interest, they're going to be using the equity method, and they will report investment income instead. If they have debt investments rather than equity investments, they might be earning interest revenue. And then finally, we've discussed how gains are a non-operating revenue item that results from peripheral transactions such as sales of assets other than inventory. So we are going to record a gain when the proceeds, or the amount of cash that we receive, is greater than the book value of the asset that we're selling. Typical expenses and losses include amortization expense and depreciation expense. So we've talked about both of these items in connection with our discussion of non-current assets. We said that amortization expense is where you're allocating the cost of an intangible asset that has a limited life to the periods that benefit from its use. Likewise, depreciation expense is also a cost allocation. Amortization and depreciation are the same basic process. We just use the term amortization if we're talking about an intangible asset, and depreciation if we are talking about a tangible asset such as plant or equipment. So depreciation is the allocation of the cost of a plant or equipment to the periods that benefit from its use. Finance cost is often a line item that you will see on an income statement, and it essentially refers to the interest expense incurred by the company on its debt obligations, such as notes payable and bonds payable. Interest is going to be calculated by multiplying the principal times the interest rate times the time, or the number of months during the current period when the debt was outstanding. One of the things that is important to note is that when you're given information about interest rates, the rate quoted is always going to be an annual interest rate. So if you need to calculate interest for a period of time less than a year, you need to cut it back by the number of months. Other administrative expenses are going to be classified as operating expenses. That's going to include executive and staff salaries, insurance, utilities, and supplies. Distribution costs are also an operating expense, and here we're referring to selling expenses. And then two types of losses: impairment losses that we discussed in connection with long-term assets. An impairment loss is a non-temporary decline in the value of an asset so that the fair value of the asset is significantly below its book value. So we need to write it down and record the impairment loss. Under IFRS, you can record a recovery of impairment back up to the original book value if the fair value subsequently goes back up. That recovery of impairment would be reported as a gain. And then losses, we've discussed and said that they are non-operating. They're recorded on sales of assets other than inventory, and you're going to record a loss when the proceeds, or the amount of cash you receive, is less than the book value of the asset. Another type of gain or loss that we've mentioned is an unrealized holding gain or loss. So the gains and losses we've been discussing are realized gains and losses because they result from the sales of assets. Unrealized holding gains and losses are recorded in connection with adjusting debt and equity investments to fair value. So we've said that the fair value measurement principle says that if you can get a readily available, reliable estimate of fair value, you want to adjust your assets and liabilities to fair value. When we make these adjustments, we record them as unrealized holding gains and losses. Some of these are going to be reported FVPL, which we said stands for fair value through profit and loss. That means that they are going to be reported on your income statement and included in net income, where others are going to be FVOCI, which means that they are going to be reported as other comprehensive income. Moving on to our equity section. An equity section is going to have certain accounts every time. The minimum accounts you would expect to see there would be share capital ordinary and retained earnings. Typically, shares have a par value. If it is par value stock, then what's going to be in the share capital ordinary account is just going to be the par value of the shares that are issued. If the shares are sold at par, at a price greater than par, which is typically the case, the excess of the selling price over the par value is going to be recorded in share premium ordinary. If a company has a second class of stock, preference shares, we would have a share capital preference, and a share premium preference set of accounts as well. So those accounts are part of contributed or paid in capital, which reports proceeds from the sale of stock. The other type of capital we have is earned capital or retained earnings. What is in retained earnings is the cumulative profits or losses earned by the business, less any distributions or dividends that is paid out. So in other words, retained earnings is the profit or earnings that has been retained and reinvested in the business. And in that sense, it's considered a source of financing because we're taking a portion, or perhaps we're taking all of our profits and reinvesting them in the business. Dividends are a reduction of retained earnings and stockholders' equity. A dividend is a distribution of profits to the owners. And then finally, treasury shares is a contra equity account, meaning that it is also going to reduce total stockholders' equity. Treasury shares are shares of the company's stock that have been repurchased. So the company has gone out on the market and bought back some of their stock. It reduces total stockholders' equity, and it also reduces the number of common shares or ordinary shares outstanding. So in a final review of our accounts, recall that the balance sheet accounts are assets, liabilities, and equity. The income statement accounts are revenues, including gains, expenses, including losses. The format of your balance sheet is assets equal liabilities plus equity. The format of your income statement is revenues minus expenses plus gains minus losses. If the number you come up with is positive, that's a profit. If it's negative, it's a loss. One final note, dividends are not an expense. They are a distribution of profits to the owners. They are not an expense, so they are not reported on the income statement. Dividends are going to be reported on your statement of changes in equity only.